Hi, I'm Tim Sustak, Chief Credit Officer with Viso Financial, and this is the economic update for March 2018. Today, we'll look at inflation, household debt, and the Fed. So, last month we talked about recent stock market volatility related to concerns over inflation. How has that played out? Well, we're still experiencing volatility relating to a number of concerns, but as for inflation overheating, that seems to have died down a bit. We recently received an updated reading of the Fed's preferred inflation index, the Personal Consumption Expenditures Index, or PCE index for short. It did show that prices have risen, coming in at an increase of 0.4% for the month of January. However, this was no more than expected by economists and did not change the year-over-year inflation rate, which remained at 1.7%. If you remember, a stronger than expected increase in January's wage statistics and what that could mean for inflation is what sparked the initial bout of volatility last month. However, that wage bump has not translated into increased consumer spending yet, as weak retail sales report for January was backed up with a tame January personal spending reading, coming in at 0.2%. This is about what was expected, and not a great start for the year. On another note, what consumers have been increasing is their outstanding debt. The Federal Reserve Bank of New York published its quarterly report on household debt and credit recently, and data for the fourth quarter of 2017 showed the total household debt level at $13.15 trillion. This is a record high and marks the 14th straight quarter that debt has increased. The good news here is that what it takes households to pay on that debt in relation to disposable income is actually at a very low level historically. This, thanks in large part to the prolonged low interest rate environment and strong employment picture. How these metrics move over time will be something to watch though. The impact of the debt burden felt by consumers in the economy will change in response to the strength of the employment picture and the movement in interest rates, as well as other factors. A look at what we can expect from the rate part of the equation after the break.
I would definitely recommend the workshop to other credit unions. It's very valuable. The sessions were excellent to learn anywhere from the current environment with today's interest rates to investing and where to put your liquidity, or if you have lack of liquidity.
I would definitely recommend this workshop to other credit unions in the area. It goes over very pertinent topics relative to the industry.
Welcome back. Federal Reserve Chairman Jerome Powell gave his first testimony to Congress this past week. Though he indicated that his outlook for the economy had strengthened since December, he also indicated that he currently sees no signs that the U.S. economy is overheating. He also indicated that wages had not yet risen as fast as one would expect given the employment picture, but that he expected wages to rise faster as the economy keeps moving forward. Overall, he reiterated the Fed's long-standing plan to raise interest rates gradually over time in order to keep inflation and unemployment in balance. The December 2017 set of Fed projections called for 3 25 basis point rate hikes in 2018, and will receive a new set of projections at the March meeting. Players in the marketplace are currently debating whether 3 or 4 25 basis point rate hikes will come in 2018, but what the markets agree on is that there's a 100% chance that the first increase will come at the March FOMC meeting. Thanks for watching the economic update for March 2018. Here are this month's release dates for some of the more important economic statistics. We'll see you again next month for another look at the economy, and as always, thanks for watching.